liabilities part, where we are focusing on three major aspects here. One being the bonds. As a part of non-current liabilities, we will try to understand the bonds. Two, we will look at leases. And three, we'll have a base understanding on pensions, pension liabilities. So these are the three major aspects we'll look at in this session. So starting off with the bond, whenever we are talking of a bond, here not investing in bonds, it's more of issuing bonds. Company raising capital through bonds. So it's like as good as a loan. Company raising capital in the form of bonds is as good as it is raising a loan. So the bond, as a characteristic of the bond, what we see is there is for every bond there is something called coupon, and there is something called maturity value, or even the face value. So coupon is something which the company pays every year. It is generally quoted in terms of percentage of the face value. Like when someone says 8% coupon bond, it means 8% of the face value of the bond is paid every year. It's just like, probably you may think of it as interest, but need not mean as interest all the time. It's some amount which the company, which the bond will pay as a regular pay. See, if you have taken a loan from me, right? The way you make the payment could be in such a way that you will pay something every year. Let's say you have borrowed some X amount from me for a 5-year period. It can so happen that you will do the repayment lump sum at the end of 5 years, just like what an FD does. I have taken a fixed deposit. They don't pay anything in the middle. The whole lump sum amount they pay at the end of 5 years. If I take a 5-year FD, right? That is one form. Whereas there could be some other instruments wherein every year some amount is being paid, and at the end of 5 years, a kind of a sizable principal amount is what is being paid. So there are different kinds of payment in terms of a loan. Either I can settle everything at the last, or I can settle some amount every year and remaining in the last. So whatever is that amount that is paid every year is what we call as coupon. In some cases it can be exactly equal to interest. In some cases it can be more than interest. In some cases it can be less than interest also. That's the reason we don't equate coupon to interest. Coupon, you have to look at it from a bond's perspective. Some amount which the bond is going to pay every year. So if I am saying 8% coupon bond, what it means to me is the borrower is going to pay 8% of the face value of the bond every year, and the face value on maturity. So typically when we talk about, if we understand this terminology, anyhow we will cover the same again in our fixed income securities also. But because that kind of understanding is required here itself, we can spend some time in terms of that understanding, so that there it becomes slightly easier for us. Whenever we hear the word coupon, right, there is always a misconception that it is equal to interest. That's not the case. These are two different words, because there could be a zero coupon bond also. It's a very common word which we use, zero coupon bond. It doesn't mean that the interest is zero there. It will still give some interest. The only thing is, every year there is no constant payment. There is no payment every year. Everything is paid in lump sum on maturity. That is what is the meaning of a zero coupon. So coupon, you have to really understand it as some payment on a periodic basis, probably every year, some amount that is typically being paid. So whenever there is a question saying 8% coupon bond and the face value of the bond is 100, what it means is at the end of 1 year I will receive 8, 2 years I will receive 8, at the end of 3 years I will receive one more 8. So every year I will receive 8, and let's say this is a 5-year maturity bond. So in the 5th year I will receive 108. These are the typical payments which the bond will be making. Right? So always look, and if I say the same instead of this zero coupon bond. So at the end of first year 0 is paid, second year 0, this year 0, and probably 100 is being paid on maturity. Face value of the bond is generally paid on maturity. Any definition of the bond goes like that. The face value of the bond is generally paid on maturity. And if there is a coupon, that is something that is paid regularly at every period. Generally year or semi-year. For some kind of bonds, we always look at it as a semi-annual kind of stuff. So every 6 months. But the quoting is always on an annual basis. 8% semi-annual bond. It doesn't mean that for 6 months it is 8%. It means for 1 year it is 8%. So payments wise you look at it as 4% per 6 months. Right? Of course. So the calculations involving them we'll look at in our fixed income subject and the valuations of fixed income instrument. But just giving you a flavor because we need to understand the accounting or the reporting aspect of these bonds at this moment. So we need to see if this is the bond, how much I should show in the balance sheet, what should I show in the P&L. Over a 5 years, what numbers are shown for each of the periods. That is what is the most important aspect as far as financial reporting part is concerned. But to understand a bond instrument, the structure is always like this. You could have a zero coupon bond or you could have a coupon bond. Coupon is like a fixed payment. I mean, it could be floating also, but a regular payment at periodic intervals. Payment at periodic intervals, intermediate, not on the maturity. Intermediately, some payments are typically being made. Those are called as coupons. So, in general, they should be fixed coupons only. But nowadays, because of the advancements and all, you will find some floating coupons, all kinds of various instruments coming up. But a typical even fixed income security, the meaning itself typically floats from this idea of fixed coupons, fixed face values or maturity values kind of stuff. Now, coming to the reporting aspect, what we will typically initially start off with is, okay, if this bond is having these kind of features, at what price is this bond currently sold at? The first aspect. Right? Now I'll see, this is the features of the bond. Now any purchaser of the bond will pay some price for it to purchase it. So let me say that this bond is purchased at probably 95 bucks. Right? If I say this bond is purchased at 95 bucks. So which means if you purchase one bond today by paying 95, this bond will give you 8 after 1 year, 8 after 2 years, 8 after 3 years, 8 after 4 and 108 after 5. Or probably let's say this zero coupon bond, you have purchased it at 70. So which means it's as good as an FD. You are paying 70 today, you will get 100 after 5 years. Right? So if this is the case, so every bond, when you are representing them on the financial statements, you need to have these 3 details associated with the bond. One, what is the coupon associated with it? Two, what is the maturity period, in how many years it is maturing and at what amount. What is the face value which matured at the maturity date, how much is being paid on maturity, and three, at what price is it being sold at today. Once we have this three information, right, the first thing that goes into the financial statements is this number, the price at which you have purchased the bond. The price at which we have purchased the bond, at the time of purchase of the bond, we'll identify the price. 95 is the price here. Now, what we'll say is, by the extent of this 95, I will increase the assets and the liabilities. Why? I have sold a bond. Now I am looking at from a company which is issuing the bond. It's not who has invested in the bond. Which has issued the bond. It got cash, 95. 95 it has got as cash today, because you have purchased my bond. Means you have given me a cash of 95, which means the assets are going up by 95 for me. And I have to repay back to you, which means the liability is also going up by the extent of 95, because it's not my money, I got it in the form of a loan. Right? So the assets are going up by 95, the liabilities are going up by 95. So whatever is the current purchase price on the date of purchase, whatever is the purchase price that is existing, by that much amount, both the assets as well as liabilities will go up, right, for that bond. These are the entries that typically get into the financial statements on the date of purchase of the bond or on the date of selling of the bond. Now I look at it from a company standpoint. On the date of issue of the bond, the assets and liabilities, both of them will go up by 95 as per this example. 95 is nothing but the price which is decided for a buy and a sell. And the money which the company is getting, that 95, goes into cash flow from financing activities. Whatever it has received, because it's a part of non-current liability, the cash flow statement wise, it goes into cash flow from financing activities. So those are the entries on the date of issue. Now, assume that it's a 5-year bond. So what do I show at the end of each year? At the end of each year, what is that amount I should show in balance sheet and probably in P&L. On the date of purchase, there is no P&L entry at all. Right? In the balance sheet, asset and liability, both of them are going up by 95. On the cash flow statement, cash flow from financing is increased by 95. No entry is made in the P&L statement. Now, what we want to see is, over the next 5 years, what are the various representations that come up? So, okay, at any point in time, if at all I want to find out what should be the balance sheet value of the bond. Today it is at 95, right? After 1 year, how much should I show it as? Should I still show it as 95 only, or should I show it as something else? For that, what the process we are following is, it will be the same for all kinds of the bond. The first step is, so for this bond, we'll show 70 as asset, increase in assets and liabilities as on the date of sale. For each of them, find out the IRR, which is nothing but annual rate of interest, which is applicable. Right? Here, 8 is not the annual rate of interest at all. 8 is something which the bond is paying on a yearly basis. May or may not be equal to interest at all. Right? It may be more than interest, it may be less than interest, it may be equal to interest. We'll see the scenarios also. May or may not be equal to interest at all. So coupon has to